Hello, everybody, and welcome to another episode of Coffee with Carl. Today, I want to talk a little bit about debt versus equity. We talked a little bit about on the last episode about funding your entity and things like this. I want to talk a little bit from the terms of what if you're in a joint venture deal with another party and what that looks like from the equity versus debt funding side. So we get a lot of questions on basically they come in as hello, hey, I'm doing a project, a joint venture, we're running low on funds, I need to put money in. How do I do that? Do I have to change the profit percentage, or do I just put money in, or do I just do it as a loan? Which is the best way? So I want to talk a little bit about that today because we do get quite a few questions on that, just simply because projects do change, needs change, and we want to be sure we know what we're doing if we have to add additional funds. So first of all, let's talk about equity. So if I'm investing equity, it means I'm just basically putting more cash into the account of the LLC that is going to be doing let's call it a flip for this example. So if I'm doing a flip and I just put money into the business or to the joint venture LLC, then I've invested equity. And technically my capital account should reflect that additional money, and even the percentages can change on the amount of ownership. So this can cause a couple different issues in that capital account. So there's a priority that gets paid out when you're doing a project. Okay, so if there's a profit on the project, which we all hope there is, and a lot of times there is, then this is not such a big deal because everybody's getting all their initial funds back and then they're splitting the profit, right? So maybe that profit's a little bit more, maybe it's a little bit less, but ultimately everybody's at least getting their investment back plus some. When we run into issues is when, say, a project is going to take a loss, or a project isn't going to be able to, more specifically, may be able to pay off the hard money lender, but may not be able to actually fully pay back those capital accounts. This is where kind of the squabbles and issues can happen in a partnership, because everybody then wants to say, well, I'm entitled to this pot of cash, or I'm entitled to more of it than you are, or you're only the equity partner. You're only the equity partner in that you're the developer. You haven't actually put cash into the project. So there's a lot of different pieces we can do within the LLC. So I'm just going to go down the route of how we generally draft them, because through our experience, this is the best solution or the best way we found it. And how to, if you need, put more money into this project, but do it at a lower risk. And that way you can hopefully at least get all of your money out, and hopefully the project is going to create a profit, in which case it all kind of becomes somewhat irrelevant. So when I fund equity, it just adds to my capital account, meaning once the hard money lender's paid, any other debt is paid, then we start looking at clearing the capital accounts, and then we divide profits after that. So that's the general sequence. So the difference is if I've got to put money into a project in order to, say, extend my carrying cost time, maybe we had a budget overrun, maybe there was something we discovered that we didn't factor into the construction budget, then what's the best way or most likely way I'm going to get my money out of this project, especially if we're running long on time, low on funds, and it's starting to look like this project may take a loss. So debt gets paid out before equity. So what I would say, or what I would suggest to most of my clients who are going to do this or bring in those additional funds, is I usually would suggest doing it as a loan to the business and not just a cash contribution which is equity in the business, because those loans actually get paid out first before the capital accounts or the equity accounts, basically. So that's why I would suggest doing debt if you're trying to put a little additional cash in order to carry a project a little bit longer, because debt gets paid out before equity. So that's a good place to use debt. I like it. You may have to, if everybody's putting in money it may make sense to do equity, but a lot of times what happens in these projects is one is the funding partner, one is the developer. So the money person tends to always be just the money person. There are variations of that. So if you come across something and you need some help for our platinum clients, you can always give us a call. We're happy to advise you on your project, what you're doing, just letting you know, so you can bounce it off somebody. Those of you considering being clients out there, always happy to speak with you on a free consultation. As you can tell, we put out a lot of free content on our channel. I would encourage you guys to go TaxWise. I would also say, you know what, come to one of our live classes. 3 days. I've never heard anybody said, well, that was a waste of time. So we look forward to seeing you at those. It's been a pleasure talking with you. I think my time is up. This is Carl signing off from Chicago today. So I'll talk to you folks later and see you on the next episode.